Your lender just approved you for $550,000. Congratulations. That's a real number that's based on your income, your debt, and your credit profile. But here's the question nobody in that conversation asked you. Should you borrow $550,000? Because approval and responsibility are two very different things. And the gap between them is where most buyers get into trouble. Not at the start, but 12 to 18 months in when the payment starts competing with everything else in their life. In this video, I'm going to give you a three-part framework for finding your actual purchase range, the number that works for your life, not just your debt to income ratio. I'll also walk you through the 4C framework I use with every buyer I work with and show you exactly how each piece shapes a number you can sustain long term. Let's simplify this. Let's start with how a lender actually calculates your approval number. And it's a lot simpler than most people think. And that simplicity is exactly what gets people into trouble. Lenders use two ratios, a front end and a back end ratio. Now, the front end ratio is your housing payment divided by your gross monthly income. Now, most lenders want to see that at or below 28%. That's very loosely, though, because most lenders really only pay attention to the back end ratio. Now, your back end ratio is all of your monthly debt, your housing plus car loans, student loans, credit cards, divided by your gross income. Now, lenders typically will approve loans at a 43% back end. Now, FHA does go higher, and I've seen ratios approved north of 55%. Here's what that looks like with real numbers. Take Mike, for example, 34-year-old in Lowell, Mass. His gross monthly income is about $10,000 a month, $120,000 annually. He has existing debt, $600 a month in a car payment and a student loan. Debt to income ceiling of 43%. That's $4,300 max total monthly debt. That means his max housing payment is going to be $4,300 minus $600 or $3,700 per month. Now that's going to equate to an approximate loan amount of $550,000 at current rates. Now the lender runs the math and hands Mike a $550,000 pre-approval letter. Clean, right? But here's what the lender didn't ask Mike. Does Mike have two kids in daycare? Is he planning to change jobs next year? Does he spend $1,200 a month on the things that make life worth living? Going out to dinner with friends, maybe traveling, playing golf on the weekends. Now, the approval doesn't know, and quite honestly, it doesn't care. That's not a knock on lenders. They're doing their job evaluating credit risk. Your job is a little different. You have to evaluate your life. There are three lenses that define a responsible purchase range. Let's walk through each one using Mike as an example. The first lens is our budget. Now, budget is what the math allows. Debt to income ratio, income rates. This is the lender's number, and it's useful. It tells you the outer boundary of what you can borrow. For Mike, $550, that's his budget ceiling. The second lens is comfort, and it's about your comfort. Comfort is what doesn't keep you up at night. What payment can you make every month without cutting into the things that matter to you? Your savings, your experiences, the margin you need to feel okay. Now, Mike runs his actual monthly expenses, and after accounting for daycare, retirement contributions, and what he won't give up, his comfortable payment is around $2,900 a month. Now, at current rates, that's closer to a loan of $420,000. And then there's the third lens, flexibility. Flexibility is about what your future self can handle and benefit from. Two things that matter here that pure math tends to ignore. First, your income trajectory. Mike isn't earning today what he'll earn 3 or 5 years from now. A payment that feels snug right now may feel very manageable in 24 months. Flexibility means giving yourself credit for where you're going, not just where you are. Second, a mortgage payment isn't purely an expense. Part of every payment is principal reduction, forced savings. That builds equity month after month. Rent has no equivalent. That equity is real wealth accumulation, and it changes how you think about what you can responsibly commit to. Now, when Mike factors in his income trajectory and the wealth building component of his payment, the range that makes sense for him opens up to $440,000 to $460,000. Now, that's not because the rules change. It's because he's looking at the full picture. This is the section most buyers have never heard in a lender conversation, and it lives inside the comfort lens. Because true comfort isn't about your monthly payment. It's about what your financial life looks like the day after closing and the year after closing. Now, most loan programs don't actually require post-closing reserves, but that's a minimum standard, not necessarily a smart one. As a homeowner, reserves shouldn't be optional. They're essential. 3 to 6 months of mortgage payments held in savings after closing is the difference between a financial emergency and a financial disaster. If your income drops, a pipe bursts, or your roof needs attention, you want a cushion, not a crisis. When we're building your comfort number, we're not just asking what payment fits your budget. We're asking what purchase price still leaves you with 3 to 6 months of reserves after closing. If that cushion isn't there, the price may be too high, regardless of what you were approved for. Budget 1 to 2% of your home's value per year for maintenance and repairs. Now, they're a hidden expense that many lenders and real estate agents don't like to talk about. On a $450,000 home, that's $4,500 to $9,000 annually. The roof, the HVAC, the water heater, they're on their own schedule and they don't negotiate. When they go, and they need to be replaced. Now, this money is completely separate from your mortgage payment, which means if it isn't accounted for in your comfort calculation, your comfort number is probably wrong. Now, there's a reflex in home buying to put as much down as possible, and on the surface, it makes a ton of sense. Lower payment, less interest, more equity. But here's what that thinking can miss. A buyer who stretches to put 20% down on a $550,000 home has committed $110,000 at closing. If that decision leaves them with thin reserves and no maintenance buffer, they've optimized for payment and exposed themselves everywhere else. Sometimes the better move is putting less down, keeping more liquidity in hand, preserving your reserves, and accepting a slightly higher payment in exchange for financial breathing room. The mortgage can be refinanced. A financial crisis 6 months after closing, much harder to unwind. Now, the goal isn't the biggest down payment. The goal is closing in a position of strength with a payment you can sustain and a cushion that protects you. Everything I've shown you so far sits inside a larger framework I use with every buyer I work with. It's called the 4C framework. 4 lenses that shape not just your approval number, but your full decision. First is context, your life situation now and whether it actually supports a home purchase. Constraints, the financial limits, income, debt, credit, cash, what they allow and what they close off. Third is your choices, the loan program structures and strategies actually available to someone in your position. And then the consequences, the real outcomes of buying now versus building a stronger position first. Now, let me show you how these 4 interact using Mike again as an example. Mike's context. He has stable income, a 2-year job history. He's planning to stay in Lowell for 5+ years. Now, that context supports moving forward. Mike's constraints. Well, he makes $120,000 a year, has $600 per month in debt, credit score is 720, $60,000 saved up, strong constraint profile, multiple program options are available. Now, Mike's choices: conventional at 5% down, FHA at 3.5%, or wait 1 to 3 years to hit 20% down and eliminate PMI. 3 clear paths with real cost differences. And the consequences. Buying now at $440,000 locks in today's price. 3+ years to put down 20% saves PMI, but costs $14,000 in price appreciation annually if the market holds. Now, that math favors acting now. When you run all 4 C's together, the decision becomes clear. Not easy, but clear. That's the point. Clarity before commitment. Let's bring it back. The lender's approval number is the ceiling of what they'll lend you. It's not a recommendation for what you should borrow. Your responsible range is going to be defined by 3 overlapping lenses: your budget, what the math allows; your comfort level, what doesn't compromise how you live; and flexibility, what keeps your options and your reserves intact. And those 3 lenses live inside a 4-part framework: context, constraints, choices, and consequences. That gives you the full picture before you make one of the most significant financial decisions of your life. Now, the goal is not to borrow as much as possible. The goal is to buy the right home at the right number and carry it with confidence from the day you close to the day you sell. If this was useful and you want to actually run these numbers for your situation, I've put together a free mortgage guide that walks you through all four C's with worksheets you can fill out before you ever talk to a lender. The link is in the description. It's called the 4C Clarity Framework. There's no gate, no sales call required, just the framework in a format you can work through at your own pace. And if you're a first-time home buyer in Massachusetts, New Hampshire, or Maine, and you want to talk through your specific situation, I set aside 15-minute planning calls every week for exactly this conversation. That link is also in the description. If this video helped, subscribe and hit the bell. I put out structured content like this every week for buyers who want clarity, not pressure. I'll see you in the next one.